Okay, good evening, everyone. Yeah, welcome to our online class for strategic business reporting in ACCA. And we're going to continue from when we stopped last time. And please, can you confirm you can hear me before we move on? Okay, thank you very much, sir. Thank you. So you're welcome once again. I was trying to wait a little bit for people to join, but obviously we needed to continue because we don't really have much time on our side, so we just have to continue from where we stopped. Okay, yesterday we started IFRS16 leases, and we said a lease is a contract or part of a contract that conveys rights to use an underlying asset for a period of time in exchange for consideration. We also went ahead to define what a leasee and a lessor is, and also we were able to also establish how to identify if a contract contains a lease. So our major focus when it comes to the accounting for a lease arrangement, we started from the leases accounting, and hopefully we also established the fact that the major amendment to IFRS 17, previous IFRS 16 on leases, is that leases are now treated as on-balance sheet financing under IFRS 16, unlike what we have under IFRS 17, where leases are treated as off-balance sheet financing. So the major implication of bringing leases as on-balance sheet financing is that the gearing position or the leverage position of a company is going to be considerably high. Okay, and obviously it's going to also affect timing of cash flows. Okay, and from there we said that the basic principle is that at the commencement of the lease, the lessee must recognize a right of use asset and a lease liability. The lease liability is measured at the present value of lease payment that has not yet been made. That's what we said. So if I'm going to pay in the future, then I need to recognize the present value of the lease payment. Then you discount using the interest rate implicit in the lease. You can remember, we also said if interest rate implicit in the lease was not given, then you can use leases incremental borrowing rates. Okay, all right. So that's what you do. So we now said your lease liability is measured at the present value of lease payment has not yet been made. So what constitutes my lease payment? Remember, we said there are 5 things. Look at fixed payment, variable payment, amount payable under residual value guarantee, option to purchase if it's going to if there's really certain that is going to be exercised and cause termination penalties. Right. So those 5 things constitutes my lease payment. So I put them together, I discount to present value using the interest rate implicit in the lease. Then from there, we also take a look at what constitutes my right of use asset. There are 4 of them. The initial amount of lease liability, any amount paid at or before commencement, and of course, initial direct costs, okay, also constitutes my right of use asset. Then the cost of dismantling or removing the asset. So those are the 4 things that constitutes my right of use asset. So I just ask a question, to supply me all those information. Then I can go ahead and debit my right of use assets. Okay. And of course, we also take a look at what constitutes my lease term. You can remember what constitutes my lease term. 3 things. You look at the non-cancelable period, then the option to extend the contract if reasonably certain is going to be exercised, an option to terminate the contract if reasonably certain it will not be exercised. So that's where we stopped last time, that's yesterday. So we're going to take a look at this question to demonstrate our understanding of that explanation. Then from there, we look at the assessing lease liability. Then we take a look at separating components. If I have a contract that contains both lease components and non-lease components, how do I account for that? And from there, we look at finance, the leaseur's accounting. IFRS16 requires that the lessor must classify a lease contract as either finance lease or operating lease. We're going to take a look at that. And the last aspect will be sales and lease back. All right. Under sales and lease back, we look at it if the transaction is not a sale, and if the transaction is a sale, what happens? If it's set below the fair value or above the fair value, what do we do? So obviously, that brings us to the end of IFRS16. Okay, so let's see. Time is going to be really, let's see if time permits us to really cover up so that tomorrow we go straight to IFRS8 operating segment, and I'll bring you up around creative accounting, and of course, we'll be progressing. So let's see. So let me do the requirements as usual. It said, calculate the initial carrying amount of lease liability and right of use asset and provide the double entries needed to record this in Dynamics financial record. So obviously, you may not expect this kind of direct question, from the examiner, but because I'm teaching, I needed to break it down. So that's why the guy is saying, calculate the initial carrying amount. So most likely, you just say something like, what will be the accounting treatment in Dynamics financial record? So let's take a look at the question. On 1st January 2021, Dynamic entered into a 2-year lease for a lorry. So when I see that statement, I know straight up that this might be talking about leases, okay? The contract contains an option to extend the lease term for a further year. Dynamic believes that it is reasonably certain to exercise this option. The lorry have a useful life of 10 years. Lease payment at $10,000 per year for the initial term and $15,000 per year for the option period. All payments are due at the end of the year. So that means payment is made in arrears because I enter into this transaction 1st January 20X1 and I will pay in December. Okay, so I would have used it. So payment is in arrears. All right. Okay. Then, okay, so in that sense, to obtain the lease, Dynamic incur initial direct costs of $3,000. The lessor immediately reimburses $1,000 of these costs. The interest rate implicit or within the lease is not really determinable. Dynamic incremental borrowing rate is 5%. So I have this question before me, and the examiner said I should compute the initial carrying amount. So in my head, I tell the examiner, this is leases accounting. How do I know? He said Dynamic entered into a 2-year lease. So it's the one, Dynamic is the one leasing, this particular lease. So in my account as a leasee, the basic principle is that I must recognize 2 things. I must recognize right of use asset and lease liability. Lease liability is measured at the present value of the lease payment that has not yet been made. Okay, so that's what I want to do. It's just my normal discounting factor, the way I discount. We have done that under IS36 when we're looking at the value in use for an asset. Is exactly what we are doing here. So how do I discount? Then I ask a question, where is my fixed payment? Okay, I told you that my lease payment has 5 elements. So that's the way I ask. I have to ask strategically, where is my lease payment? It's going to tell me. He said, lease payment at 10%, 10,000 per year. Can you see that? So this is my lease payment. But let me quickly say this, my lease term, unlike what you know before, lease term, you always say that's a lease period. But IFRS16 says lease term contains 3 things. It said non-cancelable period. So let me ask, where is my non-cancelable period? It said Dynamic entered into a 2-year lease for a lorry. Can you see? 2 years, non-cancelable period. Then number 2, option to extend is also part of my lease term. Then I ask the question, do I have option to extend? It's going to tell me yes or no. If you read paragraph 2, it said the contract contains an option to extend the lease for a further term. So that means I have 3 years. That is it. I have 3 years for my lease term. Okay, he said I have to extend. I said, and it's reasonably certain it will be exercised. Then the third one is option to terminate. If it's not started, it will not be exercised. So there's no way in this question we don't have anything of such. Then that means my lease term is 3 years. So here, it now says lease payment are 10,000 per year for the initial term. So the non-cancelable period, which is 2 years, I have $10,000. Then for the option period, he said $15,000 per option per year for the option period. That's it. Okay, so that means year 1, year 2, I have 10,000, 10,000. Year 3, I have 15,000. Did you see that? So that makes my fixed payment. Then I ask again, do I have variable payment? He did not give me any information on variable payment. Do I have amount payable under residual value guarantee? Remember, I told you what residual value guarantee, what it meant yesterday. It means it is a lease's promise that the asset will worth certain amount at the end of the lease term. Okay, so because sometimes the examiner might not use residual value guarantee. Once it tells you that the lessee has promised the lessor that this asset will worth certain amounts by the end of the lease term, then nothing. You don't need to say how to tell you that that is the amount payable under residual value guarantee. But we don't have any information, that suggests that. Then I ask again, you have option to purchase the assets, and it's reasonably certain it's going to be exercised. He did not tell me. Okay, he didn't give me any figure for that. I move on. Then the last one, they have termination penalties. So he didn't tell me I'm going to terminate. So obviously, in this question, I only have my fixed payment. Okay, so I have 10,000 year 1, 10,000 year 2, 15,000 year 3. So I have it. So I go to my table, I slot it in. I will now ask, okay, I will ask, what is the interest rate implicit in the lease? Okay, so it's either the examiner gives me interest rate implicit in the lease, but if he did not give me interest rate implicit in the lease, he will give me lease's incremental borrowing rate. And I was quick to tell you yesterday that if he gives me the two, which is rare or unusual, then I have to use interest rate implicit in the lease. The lease's incremental borrowing rate is the amount I'm going to pay, okay, the cost of borrowing I'm going to pay if I go somewhere else to borrow money and buy similar assets. Okay, for example, I go to the bank or I go to finance house, how much interest am I going to pay? That's what they mean by lease's incremental borrowing rate. So if interest rate implicit in the lease is not readily determinable, then I will use lease's incremental borrowing rate. So now most likely the examiner will always give you that figure. But in case it did not give you a figure, interest rate implicit in the lease or lease's incremental borrowing rate, you want to compute it. I'm going to tell you how to do that, okay? We use a question probably to demonstrate that. So I already see that. Then I asked, he said, the interest rate within the lease is not readily determinable. Can you see that? Dynamic incremental rate of borrowing is 5%. So I just pick that 5%, I discount to present value. So this is exactly what you're doing. So it's just your lease liability. Can you see that? So you have your dates, okay, because it said payment is in arrears, and I enter in January 2021. So I have this 10,000, my cash flows, 10,000 year 2, 10,000 year 3. So my discount factor, so everybody should know how to do discount factor. Obviously 1 plus r raised power minus n, okay. So when I discount year 1, I have this figure, that's a 9524. When I discount in year 2, I have 9070. Then when I discount in year 3, I have 12,125958. I had them up. That becomes my lease liability, the present value of lease payment that has not yet been made. So it becomes my lease liability. Remember, the examiner says calculate the initial kind amount of lease liability. I have successfully done that. So you need to remember that principle. The lease liability is measured at the present value of lease payment that has not yet been made. So your job is to remember what constitutes my lease payment. What constitutes my lease payment, okay? So you need to understand that. You need to understand that, all right? Okay, so, and I go to the other part, which is the right of use assets. I remember there are 4 things that makes up my right of use asset, like we established yesterday, and I've also done the revision, when we started, okay? So what constitutes my right of use asset? Number 1, the initial measurement of my lease liability. That's it. So what I have here, I have a corresponding debit entry as my right of use asset. Remember, at the commencement of the lease. That's the principle in IFRS 16. The lessee must recognize a right of use asset and a lease liability. So what constitutes my, how do I measure my right of use asset? 4 things: the initial measurement of the lease, the initial value of the lease liability, which is this 31552, okay? So that's why you have it here, initial liability value. Can you see that? Then I ask the question. So let's come to the question. Okay, you know, there are 4 things. I've already seen the initial value of lease liability. Then I ask the question: did I make any amount, any payment at or before commencement? It did not tell me. Okay, I've read the question. There's nothing like that. I move to the next one. Do I have any initial direct cost? It tells me, it said, to obtain the lease, the dynamic incurs initial direct cost of $3,000. Can you see that? $3,000 initial direct cost. So I come here, I slot in my, what's it called? Initial direct cost. Then I ask again. I was absent. Okay. Then I ask again, do you have any costs of removing or dismantling the assets? It did not tell me. So basically, I have 2 stuffs, you know, that are present in this question. So the examiner can fly around all those requirements, but here, it only gives me 2 out of those 4. Then I move on. He now said something. He said the lessor immediately reimburses $1,000 of those costs. Okay. So normally, you're supposed to show those transactions separately. Okay. So that's why you have this 1,000 in jacket. So when I paid the direct cost of 3,000, it gave me back $1,000. So that's the reimbursement. Okay. Sorry. Okay. So that's the reimbursement. So it gave me back. So that's why you're removing. So the value for my right of use assets is 33552. So what will now be the accounting treatment? So this figure, you start from this figure actually. When I have my lease liability, I debit right of use assets and I credit my lease liability. Okay. I think there's an error here. It should be 31. That's an error. Okay. It should be 31552. Credit lease liability 31552. So you can print that in your note over there. I think when I was typing. Okay, so I was trying to solve that. Now, so that's what you're doing. 31552. Can you see that? Okay, so then you now go to right of use assets. You know, I paid this 3,000. So normally, so since I'm paying, okay, for the right of use asset to increase the carrying amount, I debit right of use asset because money is going out. I credit cash. So that's what you have here, so that I can reduce my cash. Then it gives me 1,000 back. So since it's giving me 1,000 back, my cash will increase. I debit cash, and the value of the carrying amount of right of use asset will come down. So that's why you are crediting, you know, right of use assets with 1,000. That is the end of that first question. Nobody is going to ask you what I've just done. So the second thing we want to do now is what the examiner is likely going to ask you. However, you needed to start from here to get there, okay? Because most likely it's going to ask you what will be the kind amount of this liability at the end of the year, maybe year 1, year 2, or year 3. So what do we do? So that is what takes us to what we call lease liability table. But let me give you some few seconds. Can you take a look at this computation? Do you have any concern? About 5 seconds. We need to finish IFRS 16 today at least. Okay, so that we do something else in the next lecture. Okay, so any concern, any concern, any concern? About 60 seconds. Do you have any issue? Okay, I guess that is quite straightforward. Okay, so we don't really have any concern. Okay, now, so let's look at subsequent measurement. This is what we expect from the examiner. Okay, subsequent measurement. Okay, so you know that's the initial. What we did now is initial measurement. When it comes to subsequent measurement, think about 2 things. Okay, number 1, the carrying amount of lease liability will be increased by interest charge. Okay, the carrying amount, that's what we call the finance element. The carrying amount of the lease liability will be increased by interest charge. And normally interest charge or finance cost is taken to profit or loss account. So that means you debit P or L, that's the finance cost, you debit P or L, then you credit lease liability, because the kind amount of lease liability will be increased by interest charge. Remember, you gave me my interest rate implicit in the lease, or leases incremental borrowing rate, okay? Or leases incremental borrowing rate. Then two, that you need to know, the kind amount of lease liability will be reduced by cash payment, okay? So what it means is if I'm paying, then my liability will come down. That's the meaning. So in that case, I have to debit lease liability and credit cash, okay? I debit lease liability and credit cash, okay? So that's what I'm doing. So can you take time to look at what I just said? Before I continue. Okay, so I just have in my head that on subsequent measurements, the kind amount of lease liability will increased by interest charges, debit P or L, then I credit lease liability. Then the kind amount of lease liability is reduced by cash payments, I debit lease liability and I credit cash. It's as simple as that. So before we look at the second question, we're going to use that same question to demonstrate subsequent measurements, okay? So let me quickly explain right of use assets. Normally, because the lessee is recognizing a right of use asset, is going to depreciate, okay? So the question now is, am I going to use the economic life, the remaining economic life of that asset to depreciate? I'm sure, yeah, you know how to depreciate, right? Normally you use the useful life, okay? Or I use the lease term, okay? Or I use the lease term. In this question, the lease term is 3 years. And of course, somewhere in the question we're told that the economic life is 10 years, okay? The economic life is 10 years. So the question is, am I going to depreciate using the useful life of the asset or the lease term? Now, listen up. Now, what IFRS16 is saying is this. Listen, when it comes to depreciation, it said, if ownership of the asset transfers to the lessee at the end of the lease term. So for example, I am the lessor, you are the lessee. So I'm leasing my car to you, and at the end of the day, the ownership of that car will transfer to you. So it's ideal that when you are depreciating, remember you're going to recognize right of use asset, then you should use the remaining economic life. So you just assume that once you have the car under a lease arrangement where ownership transfers to you, then depreciate using the economic life. As simple as that. So if ownership will transfer, but if ownership will not transfer, so that means at the end of the lease term, let's say in this case, at the end of 3 years, I will take my car back. That means ownership will not transfer. IFRS16 now says depreciation should be done between the shorter of the useful life and the lease term. Ideally, the lease term will be shorter than the useful life, because obviously, I don't think I want to lease an asset that has a remaining useful life of 10 years and I lease it for 15 years. It's not possible. It doesn't make business sense, okay? So I want to lease an asset, say, that has a useful life of, let's say, 10 years. I want to lease for 7 or 8 years. So most likely, if ownership will not transfer, then I have to depreciate using the lease term. If the examiner is silent, that is the third scenario. The first scenario is has told me that ownership will transfer. I use the remaining economic life. If ownership it will not transfer, I use the shorter of the useful life and the lease term. But obviously, it's going to be the lease term because this time will always be shorter, okay? In an ideal scenario, okay? Then the third scenario is the examiner was silent. So he didn't tell me whether ownership will transfer or not. Then if he did not tell me was silent, then you assume that ownership will not transfer. And as such, I will use the lease term. That is what IFRS 15 is saying around depreciation. Okay, then we can move straight to the next question. Okay. can move straight to the next question. All right, let's see. Now, this question follows from the previous question 4. It said, explain the subsequent treatment of dynamic lease. In the year ended 31st December 2021. So this is what you expect from the examiner. You see that there was no addition to that question, okay? But because I needed to break it down, so that's why I first I'll take you out what to do around what's it called? The initial carrying amount. So if the examiner asks you what will be the subsequent treatment, then you have to start from the initial carrying amount. Because if you don't know the initial carrying amount, you will know the value you're going to transport or or import into your subsequent treatment. Is that okay? So you start, you discount to present value, okay? Then you credit straight to, or you credit to lease liability and debit to what's it called? Right of use asset. Okay. So what do you now do? We said that the current amount of lease liability is increased by the interest charges, and the current amount of lease liability is reduced by cash payments. So this will now take us to what we call liability table. Okay, liability table. So let me see. So let me just show you. This is what we have done. So I want to do the subsequent measurement now. So don't forget, once you see subsequent measurement in your exams, or the examiner just asks you what will be the accounting treatment, obviously it's asking you the subsequent measurement. So you have to start from the initial recognition, then you now go to subsequent. So immediately you want to do the subsequent measurement, you remember you need to do what we call a lease liability table. Okay, you need to do a lease liability table, and you have 5 columns. That's how to learn. So in my exams, I already know I have 5 columns to do my lease liability table. So let me see if I can show you, and I'll do some hand workings if it's required. So this is what we call my lease liability table. So I have my year-ended opening, interest, payment, and closing. Okay, so that is my lease liability table. So let me see if I can work that out for you. Let me see. Let's see. Sorry, I want to try to do some connection. Okay, so this is my lease liability table. Once you learn this, and it's very simple, even under IFRS 9, okay, financial instruments, there's something they call amortized costs. This is exactly what you are also doing there, okay, when you are measuring your financial liability. This is exactly what you are doing there. So let me try to see if I can bring that up, and I try to teach you. So you are looking at your year-end one, opening balance, interest, payment that you have made, and your closing balance. Okay, so that's what you're doing. So let's see whether I can try to bring that on board for you. Okay, so you can understand that's the technical area around that. Okay, so if I'm doing my lease liability table, I believe you can see the screen. Okay, so let me see if I can work it out. So this is so I am doing my, don't forget, lease liability. Okay, sorry. So let me just manage that. Liability. Okay, now, so I have my year. Okay, sorry. I have my year. So if you notice, we have 31st December. Then we have, that's 20x1. Then we also have 31st December 20x2. So we have opening balance. Okay. So in my opening balance, if you remember we have the carrying amount of the lease liability. If you can remember, which is 31,552. If you can remember, okay. Then I have my interests at 5%, if you remember. Then I have my cash payments I need to pay. Then I have my closing. Okay, so I just want to work it out so that you can understand. So this is what you are doing actually. Okay, so don't mind my handwriting. So I'm just getting used to this. Okay, but the bottom line is just to understand, right? So now, So now, I'm sure everybody understood how we got this 31,552. So that's what I have when I measure my lease liability. So what I now do is I will compute 5% of this figure. So you can bring out your calculator. So you do 5%, because we said the carrying amount of lease liability will be increased by interest charges. And the kind amount as at that year, as at that date, is 31,552. So I will now increase it by 5%. So I'll say 0.5 times 31,552. So what do I have? I have 1,578. Yeah, I can round up. Okay, so that's what I have. Now, I'm sure we understand that, right? So I've increased the current amount by that interest charge. Cash payment. You know, they said I'll pay 10,000 at the end of the year. You remember 10,000 year one. That's my cash flow. So you can remember 10,000 year one, 10,000 year two, then 15,000 year three. So I have my cash payment here. Okay, so I can have my 10,000 here. Okay, so how do I have my closing balance? Okay, how do I have my closing balance? Please listen to me. You know, this kind of amount will be increased. So that means I will add this together. Okay, I add this together and I remove it. I remove 10,000 from that. So I will say 31,552 plus 1,578. It gives me a figure and I remove minus 10,000. Okay, so that I can have at the end of the year, so that I can have 23,130. Okay, so that's it. That's what you're doing. So you say 31,552 plus 1,578, because the kind amount will be increased by the interest charge, but that same kind of amount will be reduced by cash payment. So you remove that 10,000 so that I can have 23,130. So in my year two, the closing balance in year two becomes my opening balance. Sorry, the closing balance in year one becomes my opening balance in year two. So here I have 23,130. Can you see that? Then I also compute 5% on that figure. So I'll say 23,130 multiplied by 0.05%, so that I can have I come here, so that I can have 1, there's a 1 here and a 5,7. Can you see that? So I have 1,157. Did you see that? Then I made a payment of 10. You can see I made a payment of 10,000. So what do? I'll say 23,130 plus 1,157. Can you see that? Then remove 10,000 cash payments. Okay. So that I can have 14,287. Can you see that? So I can have 14,287. Now, the examiner wants me to do up to year one, but I needed information in year two. That's why we have done it. So most likely, you may not require to do year two. But let me even do year three, because by year three, remember, it's for 3 years. We have the non-cancelable period of 2 years and the extension period of 1 year. It should terminate in year three. So let's test it. Let's just test it. Even though the examiner did not ask us to do this, but let's test it. So this will tell us whether we are correct. So my opening balance will now be 14,287. Then I compute my interest on that. I'll say 14,287 multiplied by 0.05. I can have so let's see, I will have 714. Okay, I think we have 0.35 there. All right, so we now have 15,000. Right, remember, year three we pay 15, so here should give me 0. It should give me 0. If I didn't get 0, it could be my typographical error, Excel error, and all of that. Oh, sorry, rounding up error. Okay, so it gives me 0. Can you see now? If I had 14,287 plus 714, and I remove 15, so I have 0. So that's it, even though the examiner did not ask me to do up to that. So I believe you understand that. Okay, so let me go back to our main slide. Okay, I just wanted to show you that. Okay, so let me go back to our main slide. All right. Yeah, so can you see now? So this is what I'm going to do for you over there. All right. So you have this opening balance. You just bring it up. You compute 5%, then cash payment, so that I can have this figure. Okay. Then this closing figure becomes my opening figure here. I also compute 5% on that figure. I remove 10 so that I can have this. So you could say that that's exactly what we did there. So you can do year 3, even though it did not ask me to do that. Now listen to me here. Okay, so let me show you here. So we now said interest of this 1578. Sorry, let me pick the 2 slides so that we are not scrolling up and down. Sorry. Okay. So you could see this interest. Now, 1578. What do? Debit finance costs. You debit finance cost, that's profit or loss, and you credit lease liability. So that's exactly what we did there. Then cash payment, reduce the kind amount, Abby. So you debit lease liability by 10 and credit cash. You see that? Now listen to me here. Now the liability has a kind amount of 2310. Listen, this is my liability. At the end of year 1, it has a kind amount of 2310. Can you see that? Now, out of this liability, I need to classify it into 2 in line with IS 1. If you remember, current liability and non-current liability. Okay. My non-current liability be due for more than 1 year. So obviously my non-current liability is going to be 14287. That's exactly why we did year 2. Okay. So the difference between 23130 and 14287 is my current liability. Once you learn that, that's all. That is all. You can successfully compute leases accounting. It's as simple as that. If you work as an accountant and your company has a lease obligation, just do this, program it on Excel. Excel will do it for you. Then you post whatever result into your, what's it called? Maybe you use your picture or whatever. Okay? So that's what you do. So you just program it. So to compute everything for you. But you need to understand how it works and you need to check those formulas that they are very correct. So this is the current amount of my liability at the end of year 1. So 14 is going to be due more than 1 year. So it becomes my non-current, and the difference between the 2 becomes my current. So that is exactly what you have here. The liability has a kind amount of 23 at the reporting date. Of this, 14 is non-current, and the difference between the 2, can you see, is current, which is this 8843. That's it. Then for the right of use assets, remember, the examiner did not tell us whether the ownership will transfer or not. So I used list term. Can you remember? So the 33 that we got for a right of use assets, okay, we now divide by 3 so that I can have a depreciation charge of 11,184. Where does that go to? You debit P or L, that's the depreciation, and credit the asset. Remember, the asset value is 33,552. So when I remove 11,184, I will have 22,368, and that is the end of that question. That is the end of the question. Any concern? Any concern before I take you the other aspect of leases? Any concern? Or where should I show you? Okay, let me show you the list table. Okay. Any concern on that or any other issue? Why? Any concern? No concern yet. Okay, this is actually very simple. But we don't know it. We don't know it. Okay. So let me check. No concern. Okay. All right. So let's go to the assessing lease liability. Okay, we're assessing lease liability. So the issue here is if lease payment is dependent on consumer index price. We talked about variable payments that constitute lease payment. Okay, so that means if changes to lease payment occur, then lease liability has to be recalculated. Okay, so that means the current amount of the lease liability will be adjusted for. That is what we call reassessing lease liability. So once changes are made to lease payment, or probably because it's dependent on inflation, consumer index price, and all of that, okay? So we have to reassess lease liability. So the best way to understand this is let's take a look at this question, okay? So let's take a look at this question. It said, on 1st January 2021, Kingfisher enters into a 4-year lease of property with annual lease payment of 1 million, payable at the beginning of the year. What we did earlier was payable at the end of the year. So what happens if I'm paying at the beginning of the year? So I'll use this question to tackle 2 issues. Payment at the beginning of the year, then reassessing lease liability. When I need to reassess the kind amount or adjust the kind amount of lease liability, right? Because there's a variable element around that. Okay, so that's what I'm using this question to do. According to the contract, lease payment will increase every year. Did you see that? Variable is dependent on the basis of increase on consumer index in the preceding 12 months. So when I see that statement, obviously I need to reassess my lease liability so that I can post corresponding adjustments to the kind amount of the lease liability. The consumer price index at the commencement is 125. So when I started, it was 125. And I was told that lease payment will increase every year if the consumer price index has increased. This is a smart way of entering into a lease liability. Then the interest rate implicit in the lease is not readily determinable. Kingfisher's incremental borrowing rate is 5% per year. Can you see that? So you're already giving me what I used to discount to present value. At the beginning of the 2nd year of the lease, the consumer price index is 140. Oh, so it has actually increased. So that means I need to reassess my lease liability in the 2nd year. Okay, so how do I do that? We're going to find out. Required. Discuss how the lease will be accounted for during the 1st year of the contract. My class, you should be able to do this. The year 1, you should be able to do it. The only one you may not be able to do is the 1st day of the 2nd year, but it's also very simple. So I'm going to take it now. So in year 1, what happens? Okay, maybe what will confuse you is the fact that payment was made in advance, because it said 1 million payable at the beginning, okay, at the beginning of each year, okay. And I remember in my memory that the lessee must recognize a lease liability and a right of use assets at the commencement of the lease. I tell the examiner. That's how I start from. I'll now say again that the lease liability is measured at the present value of lease payment that has not yet been made. Okay. Now, since I am paying now, I paid 1 million in year 1. So that means on 1st January 2021, I'm already paying 1 million naira. So what do I do? Cash has gone out. I debit right of use asset, I credit cash immediately. It's as simple as that. So let me show you that on the other slide. So I will not be scrolling up and down. Can you see? Debit right of use asset, credit cash. It's as simple as that. It's as simple as that because I'm paying now when I'm commencing. If I handed over my card to you under lease arrangement, you paid me 1 million naira. Okay? Because 1 million is payable every year. Okay? So that's what I've done. Can you see that? So that's quite interesting. But remember that what's it called? It is a 4-year lease. Okay? It is a 4-year lease. So here, he didn't tell me whether I'm extending and all of that. So it's 4-year lease. So out of 4 years, I have paid for 1 year. So the question now is, I'm going to pay in year 2, at the beginning of year 2, January 1, 20x2. But today, I need to discount to present value. I will not discount that 1 million to present value as today. Okay. So that's what you do, just like we did earlier. Can you see? So 1/1/20x2. Did you see that? I have 1 million. I discount to present value because it's in the future. Okay. So that I can have 2.72. So everybody should be able to do that. So which interest rate am I using? It's already told me. It said leases incremental borrowing rate. So I use that to discount. Okay. So immediately I discount, I will debit right of use asset and credit lease liability. So everybody is conversant with this. You can't tell me you are not conversant with this. That's what we did earlier. Is that okay? The only difference is because this payment is made in advance, in year one, we have this. So you can't do 4 years here again, because for the year one, I've already paid. I post the entry immediately. But from year 2 onward, okay, I need to discount to present value. So obviously, the current amount of right of use assets will now be this 1 million plus 2.72. That's what you have here. 1 million plus 2.72 divided by the 4 to get your depreciation. Did you see that? That's what we have there. That's what we have there. Okay. So we now do our what's it called? Lease liability table. Remember, the examiner will not ask you initial measurement alone. So you do your lease liability table. So I bring on this figure, okay? Because that's what I bring into the opening balance. Can you see? Now listen. You know, the lease liability table I just did for you has 5 columns. This will have 4 columns. Remember that I've already paid at the beginning of the year. So it's not in arrears, okay? I've already paid. So payment is gone. So what it means is I will only consider the opening balance. I will consider the interest, and I add up so that I can have what I will have at the end of the year if I am at the beginning of the year. So this is computed at the beginning of the year, okay? So I want to know the current amount of my lease liability at the end of the year. So I have, this 2.72. I compute 5%, just 5% on 2.72, 0.14. Then my closing is 286. So what happens? This will increase the current amount. That's it. So the interest charge, okay, of the liability will increase by 0.14. This is how we got the 14 here. So everybody's conversant with it. So credit lease liability. So the liability has the current amount at the reporting date of 2.86, which is this figure. Okay, that's what we did earlier. That's what we did earlier. So the only thing that was different, that's different, is we don't have payments here because it's already paid at the beginning of the year. If it was in arrears, obviously you will have payments here, and you will not have this here. Okay, so because I paid immediately at the beginning, I debit right of use assets, I credit cash immediately. Then from year 2, I will not discount to present value. That's it. So everybody can undo this. Now, in the question, we're now told that at the beginning of year 2, the consumer price index is 140. That means it has increased from 125 to 140. And as such, I need to reassess my lease liability, and I will adjust the current amount. Remember, the current amount of my lease liability at the end of the year is 2.86. So I need to adjust it. That means it has to go up. That's what it means. So I need to pay more. That's the meaning. So how do I now compute for that change? Okay, it's very simple. It's very simple. I'll just say new year over base year. So what's my new year? 140 over base year, 125. How much am I paying? 1 million. I multiply by 1 million. Okay, so let me do that on my calculator. 140 divided by 125 times 1 million. It will give me 1.12. That is the new cash flows that I'm paying. I will not discount again to present value. So let's see. So let me see that. Okay. Can you see now? So this is what I was saying. Can you see? New year over base year. That's what you just do. Multiply by 1 million so that I can have 1.12. Okay. So I can have 1.12. So I am at the beginning of year 2. Remember? I'm at the beginning of year 2. So at the beginning of year 2, I would have paid this figure now. Okay. That's my cash flows. So I can't discount it again because that's the present value. So that's why you have it here as 1. Okay. The discount will be 1. So that's why you have 1.12. But from year 3, I have to discount to present value. So it will be -1. Okay. From year 3. Okay. So that's why you have this figure here. Then you have 1.07. Then for year 4, 1.02. So if I add up, so this is what we call the reassessment of lease liability. So it has increased to 3.4 3.21. Meanwhile, at the end of last year, when I did the assessment, it was 2.86. The difference between the two, that is what I post to right-of-use assets and the lease liability. So that's what you have there. So the lease liability must now be increased by 0.35. How do we get that? This 3.21 here and the 2.86 that we have there. Okay. So this figure, I post it straight to right-of-use asset and I credit lease liability. Okay. And cash payment, of course, because I paid, I debit, what's it called? Payment will now reduce lease liability. So it will reduce my lease liability, I debit, and I credit cash. Okay. Then for my right of use asset, I will depreciate again. Remember that my right of use asset, the current amount is 2.79. So because of this corresponding entry that I posted there, it would have increased it by 0.35. Okay, so that's what you have here. So you now depreciate it for the remaining 3 years. That is the end of that question. Look at it, 60 seconds. So I can quickly explain the other aspects. Okay, I have not seen ACCA testing reassessing this liability. Okay, so I've never tested reassessing this liability. When I wrote SBR, leases came out. What they tested was the first one I told you about. I remember clearly. That's what was tested. They asked, in fact, they just told the story. If you don't know lease, you need to know the lease question. They just wrote the story. In the requirement, they said, what will be the accounting treatment? So because I'm very conversant with leases, in fact, it's at my fingertips. I know straight up, this is lease question, and I did that. So you have to explain to them. They've never tested, what's it called, reassessing lease liability. ICANN has not tested it as well. What ICANN has tested under IFRS16 is identifying if a contract contains a lease. They've never tested the solution as the computation part. Okay. Then I think in a line question, I can remember ACCA tested sales and leaseback, and we need to check that now. Okay. They tested sales and leaseback, but just ask an inline question. Okay. So they didn't test the computation part as well. So, but we needed to look at every aspect of leases. Obviously, they can't test everything. We just pick out one. So that, but you need to know everything because we don't know the ones that are going to test. Okay. So I believe this is clear. Okay. So let's now go to separating components. They've not even done. They don't even come here at all. But let's see. What separating component is saying is, if I have, if I have a contract, we said lease is a contract or part of a contract. Lease is a contract or part of a contract. That means you can have a contract that has both lease component and non-lease component. So if you like, IFRS16 permits that you can decide to treat the whole contract as a lease contract. But there's an implication to that. Your gearing level will go up. So in fact, there's other campaign scenarios to you, and I ask you to advise them on what to do. So you just advise them on both scenarios to say, if an entity prefer to treat the whole component or the whole contract as lease component, okay, so the implication is that it's going to increase their liability, okay? However, if you decide to separate, what will now be the accounting treatment, okay? Now, the standard says that if you want to go by treating the lease component in the contract, okay, the consideration in the contract should be allocated to each component based on standalone selling price, okay? The consideration, what's consideration? The amount I'm paying in the contract will now be allocated to each component, the lease component and the non-lease component, to each component in the contract based on standalone selling price. I'm not pretty sure. Maybe this is the first time you're hearing the sentence or the word standalone selling price. We're going to use it again when we come to IFRS15, revenue from contract with customers. All right. So let me quickly explain what standalone selling price is, so that I won't, bother much when we get to IFRS 15. So let's say, for example, I have a shop where I sell phone and I also provide services. Then you came to my shop to buy phone and together with the service, all right? And I said, okay, the phone worth 1 million naira, and the service I'll give you for, let's say, 1.2 million naira, for example. So because we are buying it as a bundle, okay, so I said 1 million, 1.2, so the total figure is going to be 2.2 million naira, okay, or dollars, as the case may be. Dollars? Oh, that's a lot of money. Okay, yeah, but I'm just giving examples, right? Okay, so because you are buying them together, okay, so I give you that figure. But if you want to buy them separately, you buy a phone separately, then I also provide the services to you separately in separate transaction. I'll now tell you to say, okay, the phone is 1.5 million, and for the what's it called, for the service, I'll give for 1.7 million. Okay, so that 1.5 on a separate transaction and the 1.7 on a separate transaction is what we call stand-alone selling price. So those transactions or those items I'm selling or the service I'm providing to you, they are standing alone. So that's their price. But if you are buying them together, I can reduce the price. Okay, so that's the meaning of stand-alone selling price. Okay, so the consideration in the contract, should be allocated to each component based on stand-alone selling price. So to do that, you just have to use a formula for that. Okay. No, even though most textbooks will not tell you the formula, but I just try to generate those formulas to make things life easier for my students. So what's the price? You look at the stand-alone selling price over total stand-alone price multiplied by the consideration. Okay. So I'm going to solve that question for you on the white marker board. Okay. So I'll also probably write the formula. So let's look at this question to demonstrate that. So any question you see, once you identify as a lease, so there's a component of a lease and a non-lease component in that contract, just remember that the consideration in the contract will be allocated to each component in that contract based on stand-alone selling price. So let's look at this question. It said, explain how the above will be accounted for in a switch for switch, okay, for switch, sorry, accounted for by switch in the year ended 31st December 2021. Sorry about that. Okay, now so let's look at this question. On 1st January 2021, Switch entered into a contract to lease a crane for 3 years. The leaser agrees to maintain the crane during the 3-year period. The total contract cost is $180. Switch must pay $60,000 each year, with the payment commencing on 31st December 2021. That's in arrears, right? Yeah, so this is in arrears. So that's a consideration in the contract. Can you see that? So Switch account for non-lease components separately. Can you see? So they want to account for it separately. So that means they're not accounting for it together. So they have to separate. So I need to separate the lease component and non-lease component before I will now discount to present value. That's what we are doing here. You just want to separate it, then now discount. If everything is a lease contract, I'll just discount straight up. Okay. Now, if contracted separately, it has been determined that the standalone price, can you see, of the lease for crane is 160, and the standalone price for the maintenance is 40. Okay, is 40. Okay, so Switch can borrow at the rate of 5%. So that's like this is incremental borrowing rate. So what will now be the accounting treatment? Okay, so I have issues. So what do we do? Now there are two things here. They talked about crane. Okay, so I have crane. Then they also talk about maintenance, service maintenance. Okay, so there are these two stuffs, that are there. So what do we do? Okay, so I have tried to generate a formula for us, Abi. Okay, let me go to the marker board. I'm sure you have this question with you, right? I'll try to recall. Okay, so let me just pick those figures in my head. The consideration is 60. So what the standard is saying is that consideration in the contract will be allocated to each component of the contract or the lease contract based on stand-alone selling price. So I already have my stand-alone selling price of going to be 160 and maintenance to be 40. So what do we do? Okay, 60. So I'm just going to pick up the figures. Okay. All right. So let's see. Let me go there. Let me see if I can do that. Share the screen. Oh, where's the board marker? Okay. All right. Okay. So let's clean up this. Okay. Brilliant. So let's see. Now, so if I have two components, all I need to do is to say, let's see, my standalone. So this is a formula. So you say standalone price, okay, divide by total standalone price, okay, total standalone price, then multiply by consideration, okay. Okay, so that's my formula. So like I said, you won't see it in any textbooks. All right, so I'm just trying to bring that for you. So, you know, here, so we have crane. If you remember that question, we have crane. So what happens? What is the standalone price for crane? So remember, I think is 160, okay? Then what is the total standalone for the two of them? So if you add it together, it should give you, I think, 200,000, all right? Then multiply by 60,000. That's a consideration in that. So if you press your calculator, can I quickly do that? So I will say 160 divide 200 multiplied by 60. I have 48, okay? So I have 48 here, all right? So that's what I'm doing. Then I go to maintenance, service maintenance, sorry. Okay, so what was the standalone for maintenance in that question? I think that should be 40, yeah, if I can recall. Then over total, standalone, all right. Then multiply by 60,000. If I do that, let me see, 40 divide 200 multiply 60. So that gives me 12, all right. Okay, sorry. Okay, so I have 12. Now, what I've done successfully here is to separate. So I already separated. So this is my least component. I'll now take this $48,000 to go and discount and do what we have been doing before. That's it. So this 12, because the maintenance contract, I take it straight to profit or loss account. It's as simple as that. So that's what the examiner wanted you to do. So once you can remember that formula, then you explain to the examiner to say the consideration in the contract will be allocated to each component of the lease contract based on standalone selling price. So that's exactly what we are doing. So let me show you from the, let's see, from the main slide. Okay, yeah. So let me look at the, okay, so that's it. So that's what we have just done. Can you see? So we got this 48, we got this 12. So you now discount, can you see? Just discount to present value. Already give me 5%. So every other thing remains the same. The only thing is we have a contract that has lease component and non-lease component. So just apply that formula to separate the lease component. So every other thing remains the same. Any concern? So you do your lease liability table. So can you see? So for the maintenance, you just take it straight to profit or loss account, debit or credit cash. It's as simple as that. And that's the end of that question. That's the end of that question. So let's go to what do they call it now? The leasehouse accounting. What we have been doing is leases accounting. So let's go to leasehouse accounting. Then I explain sales and leaseback. Then we say bye-bye to IFRS16. Okay. So any concern here? I don't think that should be. Once you understand this part, that is it. Okay. In case you have any concern at any point in time, please let me know. I think I explained this yesterday, that there are two exemptions to lease. Lease of low value and of short term. If you remember, lease of low value, okay, if you have a contract of low value, you don't take them as lease. What is now low value? It's a matter of judgment and materiality, okay? The lease of short term, that is, it's less than 12 months or 1 year, okay, it will not be taken as lease. So the standard gives us some example of low value items, for example, tablets, small personal computer telephone. But remember, this depends really on materiality and judgment. Okay, so you have a leases disclosure. Nobody bothers you about that, but in case you want to read it, that's fine. Okay, so okay, somebody is asking I should show the workings again. Okay, let me do that. I'm not sure I've cleaned it. Okay, so this is the workings. Or from the marker board, right? Okay, so this is it. Yeah, from the workbook. Yeah, so this is it. So let me give you some few seconds to take a look at that. Okay. All right, thank you. Thank you. Brilliant. Okay, so let me go back to, yeah, brilliant. Okay, thank you. Now, so let's go to resource accounting. Okay, it's very straightforward. It's very straightforward. So the lessor must classify the lease in his own book as either finance lease or operating lease. Okay. Now, what makes a finance lease? Normally, where the risk and reward underlying the risk and reward of the underlying assets substantially transfer to the lessee, then you say it's a finance lease. What we have here is the same thing under IFRS17. If you have ever studied IFRS17 before now, okay? So the same thing we have here is what we still have. The only part that changes is what we've done. That's leases accounting. Okay. So the finance lease is substantially risk and reward has passed to the lessee. Then IFRS now goes further to tell us that if one or more of those points is present in a contract, then that may suggest that it's a finance lease. Obviously, I won't be able to go through all these points, but let me just speak about 1, 2, 3. And for example, said ownership transfer to the lessee at the end of the lease term. So if ownership is going to transfer, then I say it's a finance lease. Okay. Now, do you know the reason why you might need to learn this? You might need to learn how to classify if a lease is a finance lease. Okay. He can give you a scenario and ask you to identify, or he could tell you that the directors are struggling with, or classification, whether it's a finance or operating lease. So it's not left for you to read the scenario and find any of these points in that scenario that will suggest that it's a finance or operating lease. All right. So if ownership is going to transfer, then it says a finance lease. The lessee has the option to purchase the asset less than its expected fair value at the date of the option becomes exercisable. And it's usually certain that it will be exercised. Okay, so you can just summarize that I'll purchase the asset less than the fair value. Okay, the lease term is of major parts. That's what we know. For example, if the lease, the useful life is 10 years, and I'm leasing the asset for 7, 8 years, then it's technical. That technically means I'm leasing it for significant parts of the asset life. So that is what's it called? A finance lease. At the inception of the lease, the present value of the lease payment, of the lease payment amount to at least substantially all of the fair value of the lease asset. Then the lease assets are specialized in nature, so that the lessee can use them without modification. Can you see? So you have them there, so you can just go through them. Then the lease will compensate the lessor for their losses, gain and loss from fluctuation of the fair value of the residual fall to the lessee, for example, by means of rebate and the lease payment. Then the lease can continue the lease, or the lessee can continue the lease for a secondary period in exchange for substantially lower than market rent. So any of this can feature in a scenario question, then we can determine whether it's a finance lease or operating lease. So let's look at this question to see that. I said IFRS16 leases, should the lease be classified as an operating lease or finance lease? Okay, normally, if an operating lease is where the risk and reward incidental to that asset remains to the lessor. Okay, in fact, most times you see the lessor that will carry out maintenance and all of that on that particular asset. Downboard is a lessor and is drawing up a lease agreement for a building. The building has a remaining useful life of 50 years and interested in this, maybe it's going to be useful. The lease term will commence on 1st January 2016 for 30 years. But the question is 30 years significant? You know, once I lease an item or a significant part of the useful life of that asset, then I consider it as a finance lease. But I really don't. So that may suggest that this is a finance lease. Danboy will receive 40% of the asset value upfront for the lease. At the end of the lease, for the 30 years, Danboy receives 6% of the asset fair value as at 1st January 2020. Legal title at the end of the lease remains with Danboy. The legal title will remain with the lessor, but the lessee can continue to lease the asset indefinitely at a rental that is substantially lower than the market value. Is it part of what we said here? Can you see at the inception of the lease, the present value of the lease payment amount to at least substantially all the fair value of the leased asset? Then the lease term is for a major part of the economic life. Did you see that? Okay. So now, and if the lessee cancels the lease, it makes a payment to Danboy to recover the remaining investment. So this statement alone already to tell us that this is a finance lease and what we have here earlier. So you can see the answers there. So from the answer, it tells you start with the requirements. So you list the requirements. So you just have to wait to learn 2-3 points around here. So let's see. Now let me just pick 1 or 2 here. Said now the lease term is only for 60%, 30 over this for the useful life. Legal title will not pass. So this might suggest that it's an operating lease because legal title will not pass. Well, however, the lessee can continue to lease their assets for lease time for a value that is substantially below the fair value. Okay, that's market value. This suggests that the lessee will benefit from building over the entire useful life, and therefore is an indication that it's a finance lease. Okay, so just try to learn that so that in case the examiner gives you a scenario question, you should be able to identify if a contract contains a lease. Okay, sorry, a finance lease rather. Okay, now, so let's now look at treatment of a finance lease. Remember, is in the account of the lessor. Okay, now, what the examiner, what the standard is saying is that at the inception of a lease, okay, lessor will now measure it at the present, we present the asset held under finance lease as receivable, okay? It's going to present it as receivable. And how do you measure the receivable? It will be the present value of the fixed payment, like we have learned earlier, if you remember, variable payments, residual value guarantee, even unguaranteed residual values also here. Option 2, purchase and termination penalties. You know that we have 5, here you have 6. 1, 2, 3, 4, 5, 6. Yeah, that's 6. So the only thing that they introduce is unguaranteed residual value. So it's the same thing that you learned under leased payments that you're repeating here, okay? So you recognize it as receivable. So you measure at, you take it as receivable because it's a finance lease. So how much am I receiving? Receipts, okay? So the kind amount of your receivable, that's lease receivable, will be increased by finance income earned, okay? You know that will be finance income, that's the interest element. It will not be the finance income for you, okay? And the kind amount will be reduced by cash received, okay? So by cash received, receipt or received, how you want to use. Okay, so that's what is happening. So that's a subsequent measurement. So obviously, this is quite straightforward. So now here, in this question, VACHE or VACH leases machinery to Toro. The lease is for 4 years, annual cost of $2,000 payable annually in Naira. So the present value of lease payment. So if you did not give me this present value, I know how to do present value. Everybody should know how to do present value by now. So because you have learned present value, that's why I'm not picking questions that would still require us to do present value. But he has already computed it for us here. Is a 5,710. Okay, 5,710. So the interest rate implicit is 50%. So how should VACH or VACHE account for their net investment in lease? Okay, so how did I know here it said VAT leases machinery to Toro, and it's for 4 years. Okay. So now, so what do we do here? Normally, because I am the lessor, so if I'm taking it as finance lease, I recognize a receivable. And how do I measure my receivable? To be the present value of lease payment that I'm expecting. So, and they told me that the present value already is 5,710. So it has already computed it for me. Now, I will now go to subsequent measurements. Okay, you know, we said the kind amount of the receivable will be increased by finance income, and the kind amount will be reduced by cash receipt. So what do? I do my table again. You know, the other time we did the lease liability table. Now this one is a lease receipt or lease receivable table. So I have my year, opening balance, finance income, not interest. Cash received, not cash payment. Then closing balance, just like we did earlier. So I will now bring that present value. You know, he has computed it for me. If he did not compute for me, I will discount to present value. I look at fixed payment, variable payment, residual value guarantee, unguaranteed residual value. Okay, amount purchase, option to purchase, termination penalties. I put it together. I discount to present value. But as discounted it for me here, okay, I'll now compute the finance income. I just compute 15% or 57110, so that I can increase the kind amount by the finance income, and I reduce it by that 2,000. You know, this 2,000 I'm paying cash received. My opening balance in year 2. I perform the same operation up to the end of year 4. At the end of year 1, okay, my net investment is going to be my receivable, what I'm expecting as my non-current asset. You know, it will be due for more than 1 year. It's going to be 3,251. Okay, so the difference between the two will be my current asset. It's as simple as that. So that's what you have here. So if you do 4, 5, 6 minus 3,251, we get 1,351. There's a complex way to also get it, but that one is straightforward for you. So that's what you do. So that is what happens in the lessor's account if he has classified this asset as a finance lease. Okay, that's it. You recognize a receivable. That's all. Okay, so that's what you need to learn there. Operating lease is also very simple. The lessor will recognize the income from an operating lease on a straight line basis. If I'm expecting 1 million naira for how many years? 5 years. I just divide by 5. That's it. On a straight line basis. It's as simple as that. So let's look at this question, for example. Orok hires out industrial plant on long-term operating lease. On 1st January 2021, it entered into a 7-year lease on a mobile crane. The term of the lease are 175 payable on 1st January 2021, followed by 6 rentals for 70,000 payable on 1st January 20x2 to 20x1. The crane will be returned to Orok on 31st December 20x7 to be returned. That means there's an operating lease. Okay, the ownership will not transfer. Now, the crane originally cost 880 and had as a 25-year useful life without useful life with no residual value. It's called the accounting treatment, okay, of the above. So this is an operating lease. So what do we do? Now, in the statement of financial position, obviously, this is the cost. So Orok would have recognized a depreciation of how much is that? So you just do 880 divided by 25. 880 divided by 25. So let's see. So give me 35.2. Okay, so that's 35,200. So we would have recognized a depreciation. Now, the rental income, you know, is an operating lease. Okay, so the rental income must now be recognized on a straight line basis in the profit or loss. So I look at the question, how much is my rental income? It said 175 payable on 1st January 20x6, followed by 6 rentals of 70. So that would be 70 times 6. It gives me 420 plus 175. So my rental income is 595. So that's how I got this 595 here. Okay. So because it's 595, and I'm going to pay for 7 years, okay, I divide by 7, straight line basis, 85. So that's how you have this 85, okay? Divide by 7. Because it's going to be on straight line basis, very simple, operating is straight line basis. Now, in the center of financial position, you know, my total figure, the total amount I'm expecting is, how much is that? 595, remember. Okay, so, and the terms of the lease is, so 175 is payable at the beginning. That's on 1st January 20x1. Okay. So meanwhile, this guy followed by how much? 70,000 payable. So by the time you did you do your computation, so annual payments normally will be 85. So that means out of this 85, there's a portion of 175 and there's a portion of 70. Okay. So I remove that 85 from that 170, so I have a deferred income of $90,000. Okay, so that's what they have done. What they have done there. So normally, all you need to do is take a look at the rental income. The complications that can be there is what the examiner has told you here to say 175 in year 1 and 70,000 payable for 6 years. So you need to multiply by 6 so that you get the total figure and add to this 175 and divide by the lease time, which is 7 years. How did I know it's 7 years? I'll pay here 1, then followed by 6. Okay, so that's what you're doing, and that is all. So you also have the source disclosure. So the last part, let me borrow about 5 to 10 minutes of your time so that I can explain sales and leaseback. What does that mean? I need money. But I cannot raise money by way of equity or by way of debt. I can think of sales and leaseback. So I sell my plant and I lease it back. So automatically, I am the seller leasee. Okay, I am the seller leasee. All right. So that's what I mean by sales and leaseback. So the guy that is buying from me is what we call the buyer leaser. He's buying first, then he now lease it back to me. So that's the buyer leaser. So, but the issue here is this: I needed to determine first whether that transaction is a sale. Okay, I need to apply IFRS 15, revenue from contract with customer. So that was why when IFRS 16 and IFRS 15 was issued, you have to apply the two at a time. You can't say I want to apply IFRS 15 and IFRS 16. You have to do the two at a time. Okay, so because of the accounting complication. Now, so you need to determine if performance obligation has been satisfied. So when we do IFRS 15, we understand better. But let's just take a look at the sales and leaseback. They are into two. If the transfer is not a sale, you just treat that proceed as a loan. Please take notes. The examiner can dribble you, gives you a scenario, okay? And it tells you that they didn't comply with IFRS 15, revenue from contract with customer, and is asking you, how will that transfer be treated? It's simply as a loan. So if transfer is not a sale, then IFRS 16 says that in simple terms, the transfer proceeds should be treated as a loan. Is that okay? Now, but if the transfer is a sale, so most likely I have sold it at fair value, for example. Okay, so the seller and the lessee must now measure the right of use asset as a proportion of previous carrying amount that relates to the right retained. So you measure it as a proportion of previous carrying amount that relates to the right retained. How do we do that? I will also try to generate a formula for you so that you understand. You can just apply that formula. So if that transaction is a sale, so they will tell you this transaction is a sale. So you have to measure it as a proportion of previous carrying amount that relates to the right retained. So what do we do here? So let's look at the question to demonstrate that. So all you need to learn here, there are two things that I've told you. If the transaction is not a sale, please take notes, especially ACCA candidates, okay? they create a scenario and it's not a sale, you treat it as loan. That transfer proceeds, you treat it as loan. But if it is a sale and it's sold at fair value, okay, so you treat it as what's it called? You measure the right of use asset as the proportion of previous kind amount that relates to the right retained. So let's look at this question to demonstrate that. On 1st January 2021, painting sells an item of machinery to cottage at its fair value of 3 million. Did you see? It's sold at its fair value. It is possible I sell above the fair value. If I sell above the fair value, that addition is treated as additional financing. I am coming there. If I sell below the fair value, that difference between the fair value and the amount I have sold it is treated as prepayment. Once you learn those stuff, that is all. That's the end of sales and leaseback. But here, I sold at fair value, and I have to measure the right of use asset as a proportion of previous kind amount that relates to the amount retained or to the right retained. Okay, so that's it. So now said, on 1st January 20X1, painting sells an item of machinery to cottage for additional for its fair value of 3 million. The asset had a kind amount of 1.2. So let me just be highlighting it, as we, kind amount of 1.2. I'm also interested in the, what's it called? Fair value. Okay, now these sales represent this, the satisfaction of performance obligation in accordance with the IFRS16. So it is a sale. I don't have a problem with that. If it is not a sale, that person will be treated as loan. Okay. Now, painting enters into a contract with cottage for the right of use asset for the next 5 years. Okay. Oh, 5 years. All right. So after, so the annual payment is 500,000. Okay, due at the end of each year. Okay, brilliant. So I'm also interested in this. Now the interest rate implicit is 10%. The present value of annual lease payment is 1.9%. Okay, sorry, 1.9 million. The remaining useful life is machine is much greater than the lease term. That's fine. So now to explain how the transaction will be accounted for on 1st January 2021 by both painting and cottage. That's the seller, lessee, and the buyer lessor. Okay. So now, so what do we do here? Now, so when I see this transaction, I already know that this is a sales and leaseback because it said painting sells. So I sold to cottage at its fair value. Okay. Then painting enters into a contract with cottage for the right of use asset. That means I'm buying back. Did you see that? So that's a sales and leaseback, and I sold at fair value. Okay, so what will I do? Now, the standard says the right of use asset must be, you have to measure the right of use asset as the proportion of the previous kind amount that relates to the right retained. So you measure it at the proportion of previous kind amounts that relate to the right retained. So what do I do here? So let me generate a formula for you. Let me see if I can do that on the white marker board. Well, let me pick out those figures so that I can try to do that for you. So the formula is you look at present value, okay, of the lease payment over fair value multiplied by the kind amount. That's the formula. You won't see it anywhere in textbook. So I'm just trying to create those formulas so that we can understand. So look at present value. So when I look at this question, what is my present value? Okay, what is my present value here? It said present value of annual lease payment is 1.9 million. Can you see that? So what is my fair value? I sold at 3 million. So what is the previous kind amount? 1.2. Okay, did you see that? So let me try to see if I can do that. Remember I said we must measure the right of use asset as a proportion of previous carrying amount. So that's why you are multiplying by carrying amount. So the figure I get is what I undo. So let me see if I can do that. Okay. All right. Let's see. Can I share? All right. So let me pull out this. Okay. So I am looking at. Sorry. We are still. Okay. So here now, oh sorry, let me pick the, okay, yeah. So the sale, you know, here we are saying transfer. Okay, let me transfer is a sale. Okay, transfer. Oh, sorry, transfer is a sale. So obviously, I sold at fair value. Okay, so if I sell at fair value, if I still say I have to measure right of use as a proportion of previous kind amount that relates to the right within. And I told you that I just apply this formula. So you look at present value over what's it called, fair value, okay, then multiply by kind amount of that asset. So in this question, our present value, remember, that asset is 1.9 million, okay. So what's my fair value? I sold it at 3 million, Abby, 3 million. That's 3.0, okay. So multiply by carrying amount, that should be 1.2 million, okay. So what will this one give me? So let me press my calculator. So it will be 1.9 divided 3 multiplied by 1.2. Okay, so it's going to give me 0.76 million. Okay, so you can do that. So can you put that down in your notes? I'm not sure. I already formula in that notes. Okay, so that's what you're doing actually. If the sale, if transfer is a sale and it's at fair value. So what do we do to this 0.6 million? So I'm going to show you shortly. Okay, that's what they are saying. As proportion, you measure the right of use asset as a proportion of previous kind amounts that relates to the right retain. Okay, that relates to the right retain. So let me come back to the main slide. Okay, so this is my question. Let me use this. This is far. Let's see. Sorry. Okay, all right. Okay, so this is what I did. Can you see? This is what I just did up there. So that's how you get this figure. So because I sold, right? In my own account, remember, I'm the one that sold. Let's see, painting sales. So when I sold, I received cash of 3 million. I debit cash. Did you see that? Then the right of use asset, I have already measured it. You know, it said measure right of use asset as proportion of previous carrying amount. So I debit my right of use asset. Then, you know, the previous carrying amount of that machine is 1.2. I remove it straight up. That's the 1.2. Is in the question. Let me show you. Can you see carrying amount 1.2? So I remove it. So I credit it. Then the lease liability. How do I get my lease liability? It said present value. What is it? Present value of lease payment. It has computed it for me. So I credit my lease liability. So the balancing figure is my 0.6. That goes to my P of L. Okay. So if I had 3 plus 0.76, if I remove it from these two to give me this. Okay, so I credit straight to P of L. This is a complex way of getting that 0.6, but don't need to bother yourself. Just look at the balancing figure, and that's all. Now, in the books of college, they will only debit the machine, you know, when they bought it, debit and credit cash. It's as simple as that. And credit cash. It's as simple as that. Sorry, I borrowed 10 minutes. We have 2 minutes more, but I needed to explain the last aspect. So this is the last aspect. Okay, this is the last aspect. So let me show. Let me see that. If the transaction is not at fair value, you know, I mentioned it earlier. What we did now, it was at fair value and it complies with IFRS 15. So if I sell below fair value, I treat it as prepayment. If I sell above fair value, the difference is I treat it as additional financing. So there's no accounting implications and prepayment, very straightforward. But let's look at additional financing. Then we can call it a day, okay? We can call it a day. So let's see. On 1st January 20X1, Mosaic sells an item of machinery to ceramic for 3 million. Its fair value was 2.8 million. Okay, can you see that? I sold it for 3 million, but the fair value was 2.8. So I sold below the fair value. So the difference between the two, if I take it as additional finance. The asset had a kind amount of 1.2. So it's just the same principle. We're still going to apply. Okay, the only difference is that additional finance that becomes a financial asset. Okay, so the sale represents satisfaction in line with IFRS 15. Mosaic enters a contract with the ceramic in light of the use of asset for the next 5 years. Annual rental payment is 500. Okay, are due at the end of the year. The interest rate implicit is 10%. So the present value of lease payment, is 1.9. Oh, it's even the same question, just that the sale was below the fair value. So what do we do here? Now, let me just put this on the question. Let's see. Yeah. Okay. Now, so what do we do here? We still do the same. The only thing is, you're going to look for the difference between the fair value and the sale. You know, the fair value was 3 million. We sold at 2.8. So that difference is treated as additional finance. That's the excess of sales proceed. So it's additional finance. So the present value of lease payment, which is 19, is now assumed that 0.2 million relates to the additional finance of the relate, and the remaining 1.7 relates to the lease. So what do? We apply the same formula, present value over fair value. So what is now my present value? What's my present value now? You know, my present value here in the question, let me go back to the question, is 1.9. Is that okay? So that effect of additional finance, I will remove it from 1.9. I'll remove it. So that's why we have 1.7. So divided by the, what's it called? The fair value, okay? So how much is the fair value? 2.8. Can you see? 2.8. So that's why we have the 2.8 here. They multiply by the kind amount, 1.2. So this is my 1.2, remember? Can you see? So that's it. So the only thing is that additional finance will affect my present value of lease because it's an additional finance. Why am I selling above the fair value? Okay, so that's the only difference. So you apply your accounting entry, and that's the end of that question. So because I'm selling, okay, because I'm selling, I debit cash for that 3 million that I received. Then I debit right of use asset. So this figure, because we are still going to measure the right of use asset proportion of kind amount that relates to the right retain. The previous kind amount that relates to the right retain. That's what I did earlier. The only thing is we are removing that additional finance from the present value. That's the only difference. Then you credit your machine with the kind amount, then you credit, so then you credit your lease liability with this 1.7, okay? And of course, financial liability. So that's what is coming here. Is a liability, additional finance, okay? The balancing figure 0.63, and that is the end of that question. In the ceramic account, they will now introduce that additional liability or additional finance will now be a financial asset in his own book. So the credit cash, the money has gone out. The debit machine 2.8 and the difference 0.2. How did you get that 0.2? Let me show you again. We simply remove the fair value and from the sales proceed. It's as simple as that. So in their own account, that's what we have. And that is the end of IFRS 16. Thank you for staying tuned. I think I took about 15 minutes more. Thank you for your understanding. I just needed to finish IFRS 16. Then tomorrow, by God's grace, we'll take a look at IFRS 8. And we'll have some time to discuss creative accounting and window dressing. So thank you for your time. Any concern? In the next couple of minutes before we call it a day? Tina, I hope you enjoy my marker board. I have to look for it. I'm going to buy it. So I'll be using, yeah, thank you very much. At least an improvement. So I'll be using it to do some technical areas. So don't mind my handwriting. So maybe after some time, I'll be used to it. Okay, so thank you for your understanding. All right, so tomorrow. Oh, okay, that's brilliant. So this is sufficient. I love that. Thank you for the encouragement. Thank you for being with us. Thank you for understanding. So tomorrow, we look at the other standard on the notes. So next week, by God's grace, we'll continue our group accounting. So we go to complex group accounts. I think we are on course. All right. Thank you, and have a wonderful night rest. Take care. Good night.